The views, comments, and opinions of the following program do not necessarily reflect those of Morris Media Studios, MorrisMediaLive.com, or its affiliates. Listener discretion is advised.
Good afternoon, good Thursday, April 22nd, 2021. Good afternoon, everyone. It's your girl, Shirley Nichols with Mortgage Money with Shirley. So this is my new podcast, episode 3, Loan Programs Part 2. As you all know, we had episode 2 with Loan Programs Part 1 a couple of weeks ago. So again, you're tuned in now with your girl, Shirley Nichols. I am a mortgage broker. My NMLS number is 105989. I am a mortgage broker with Clear Sky Mortgage and Realty. And we are here, Los Angeles, Culver City area, right across from Howard Hughes Center. So welcome to my podcast, Mortgage Money with Shirley. I will be coming live and direct to you the first and third Wednesdays of the month. Now, I know it's Thursday, and I have said before in my previous podcast that I'm going to come to you the first and third Wednesday of the month, but something happened, something got in the way yesterday, so we're here on Thursday, and I would not miss a podcast for you. I want to be here with you all twice a month, trying to give you the tips and the tricks of what I know about mortgage business. I've been in the mortgage industry now for 28 plus years, something like that. I know, I look 12, but no, seriously, I have been in this mortgage industry for quite some time, seeing the highs and the lows. As you all know, with mortgage interest rates, that's what we do here in this business. It's a cyclical roller coaster type thing, and it goes up and it goes down. And the key and the trick is to, when you're eligible and qualified for loan purchasing of a home or loan refinancing of a property, do it. Just simply do it. And I hope that I can share with you some of the stuff that I know over these 28 plus years of being in this business. I hope to share with you some of the tricks and tips that I know, and I shouldn't even call them tricks, so let me just stop saying that. But some of the tips that I know about the mortgage industry. So again, tune in live. We are streaming live also on YouTube with Morris Media Studios. Again, YouTube live streaming with Morris Media Studios, or you can find us right here on Facebook as well. Also, if you have questions, comments, concerns, and you want to call into the studio, we'll take your calls at area code 323-815-4204. Again, that's 323-815-4204. So call in, ask questions, or leave your comments right here in the Facebook chat. It's all good, and I'll promise to get back to you. Okay. So again, today is episode 3. We're talking about loan programs. And let's get into that. So I'm going to kind of replay a couple of things from a couple of weeks ago, what we talked about with loan programs. We went over the government loans, FHA, VA, USDA loans. And the USDA loans, for you all who are wondering what that is, it's actually for the rural properties. If you live in a rural area, there's a lot of programs for those who are wanting to purchase in a rural area or refinance a property that is in a rural area that is under the USDA program, and there's a lot of perks with that. And then, of course, your VA loan and your FHA loan are the government loans. We also talked about the conventional loans. Okay, you have the jumbo, the non-conforming, the conforming loans. Those are your conventional loans. So we can talk about those loan programs as well. But I wanted to kind of jump into what we talked about, like I said, a couple weeks ago with the loan programs. One thing that I want to point out and just get into right away is the application process. I had a couple questions about that over these last couple of weeks. What seems to me is so routine, taking credit applications and all that good stuff to either purchase a home or refinance a home. It seems routine to me, right? Because I've been in this business for so long. But I want to kind of step back a little bit and make sure that I get into the application process with you all, especially now that we are in the midst of tax season and the income taxes are due May 17th of this year. So you have a little bit of time, but let's just talk about this real quick because I bring up the tax season and filing your tax reports for a specific reason. And like I said, I kind of want to go into the credit application and then we'll touch on these tax reports, okay? or tax returns. So again, the credit application, don't get nervous. Just pick up the phone. That's the first step. Pick up the phone. And you heard me correctly. I said pick up the phone, not jump online and start typing in. If you are a first-time home buyer, or if you are a seasoned refinancer, loan home purchaser, whatever, if you are seasoned and if you are just starting out, pick up the phone, okay? Pick up the phone and call your mortgage broker. Primarily me, but call your mortgage broker and talk to them on the phone about the credit application, because that would hopefully ease some of the fear or some of the angst that you may have when you're trying to do a credit application, because it's really not scary, guys. It really isn't. I know you're saying, but that's because you're in the business, Shirley. No, seriously, it is really not scary at all to take the first step, which is to pick up the phone. Okay, you're going to give them your name, address, date of birth, social security number, where you're working, how much you're making, and how much you have in assets, right? And that's pretty much what you're going to do. And then we're going to type all that in the computer, and we're going to pull a tri-merge. A tri-merge are all three credit reports, okay? We're going to pull all three credit reports at one time. That's your Experian report, Equifax report, and TransUnion. We're going to pull all those three reports at one time. And then we're going to give you the middle score. That's what you qualify for. And like I said, over these last couple of weeks and months, I've had several questions that come up and say, oh, Shirley, but I know my Credit Karma score says 800. But Shirley, when you pulled it, you said it's a 700. That's a whole nother conversation, and that's going to take a long time to kind of get into. Bottom line is this: Credit Karma, freecreditreport.com, get your credit scores here. All of those things have their own set of formulas, basically. That company may have a set of formulas where they use to say, okay, we've combined all your demographics. We've combined all of the credit balances and outstanding payments that you have. We've combined all this stuff, and then we put an extra margin on that. And so here's your credit score, right? And that's what Credit Karma, freecreditreport.com, get your free credit score here. All of these website internet bases, they have their own matriculation of a formula that pretty much devises and spits out a score to you. That formula that they're using is a little different than what we use in the lending world, in the mortgage world. So that is why a lot of the times you'll see when you pull these online internet scores, you will pull them and your score is way higher than what we as mortgage brokers or the lenders will get. We pull a tri-merge, and you may often say, well, my score was an 800 with Credit Karma, Shirley, and you told me it's a 700. Well, we're going to tell you the middle score, okay? And like I said, it's the middle score that qualifies you on whether you're going to refinance, purchase a certain amount of home. That's what we're looking for to qualify you on, is that middle score. So we don't give you, the high score, which may be your 800, right? But we're going to give you that middle score because we're not going to give you that low score either. Remember, we're pulling a tri-merge so we can get the broad picture. So with that, we can get the broad picture of what your credit profile really looks like and of what you can afford. Okay. So again, call your broker, call Shirley. You're going to call me and you're going to say, hey, my name, number, social security number, my address, my date of birth. Here's where I'm working. Here's how much I'm making. And again, how much you're making is important. Okay. If you are paid once a month, that's what you should tell me. Not, oh, I think I'm paid every other week. That's not once a month. If you're paid twice a month on the 15th and 30th, that's not every other week. So it's you got to be real careful about how you're posing, how you get paid. And I hope that before you get out of bed and go to someone's job, that you know how much you're making, right? And I can't tell you, that's one of my pet peeves, my personal pet peeve is when I ask someone, well, how much do you make? Oh, geez, let's see. Well, I think my boss said I was going to make, well, I think we get paid on the 15th. How do you know what you're not making or when you get paid it before you get out the bed? Like, I'm not going to put my shoes on and grab my handbag and go anywhere unless I know how much I'm making that day or the salary, So again, we're going to take your credit application. We're going to ask you how much you're making. We're going to ask you how long you've been at that company. Now, I get this question as well. Oh, I just switched jobs yesterday. No problem. Do you have an employment gap? That's what we're looking for. When you're applying for a mortgage application, we are looking for your employment history, and hopefully it's 2 years worth, right? So we want you to have a 2-year history of consistent employment. Now, if there are gaps or if you switch jobs, no problem. You switched your job. Everyone does that. It's okay. Not a problem. But it's the length of time between the next job and that job that we're looking at to see if there really is an employment gap. And don't think that, oh my gosh, I haven't worked in 6 months. There's a huge employment gap. Don't think that's a major issue because, again, there's workarounds for all of this, okay? But if you just switched your job, and let's just say you were a hairstylist, right? You were a hairstylist last week, but this week you're a doctor. Well, now we've got a problem. We've got a little bit of a concern. So bottom line is it's okay to switch companies, but hopefully you're not switching the line of profession that you're in, right? So if you've been here as a hairstylist at ABC Hair Salon for, a year, and then next month you switched over to 123 Hair Salon, but you're still a hairstylist, but you had just like maybe a 30-day gap, no problem. Do not ever think if you're in the same line of profession that because you stopped one company and went to that next company that you've got this employment gap and, oh my gosh, I'm not going to qualify. Don't think that is going to be the case, okay? You are allowed to switch companies, all right? What we have a problem with, where there's a little bit of a concern, like I said, if you go from a hairstylist and now you're a surgeon, that might be a little bit of a concern, okay? So I will say that about the application. So we pull the application, right? We put all the information in, and then we pull your tri-merge. And then I'm going to call you and say, hey, guess what? Congratulations! You qualify for XYZ. Based off of the income that you told me that you're making, here's what you're going to qualify for, right? And that's why I said it's very important to make sure you know how much you're making and when you're paid. Okay? There's a little bit of a difference when you're paid twice a month, and that's 24 payments over the year versus every 2 weeks when that's 26 payments over the year. So there's a little bit of a difference, and that will cause your scales of how much you qualify to go unbalanced. So you want to make sure what you're getting paid, you know it. All right? So first step, get the credit application done and get your scores. Now let's talk a little bit about the FICO scores. Hello, hallelujah, thank you, Jesus. The credit scores have started to go back down as far as eligibility requirements go for government loans. This is huge. When the pandemic started, every lender in town started increasing their credit score requirement, right? It was easy to get an FHA or VA, the government loans we just mentioned, FHA, VA, USDA. It was simple to get those loans because you could have a credit score of a 590, a 595. You can get something in the fives. But as soon as the pandemic hit, credit scores went up, right? They went from the 590-ish range to 640. And every one of the clients that were qualified at the 590-ish that hadn't closed, now we have a small bit of a problem, right? So now, newsflash! Okay, as of about a month ago, so we'll give it maybe about 3 or 4 weeks ago, those scores went back down for FHA, VA, USDA. And when I say back down, they're not in the fives yet, but 620, which is a huge drop from the 640 to the 620 in our world, right? We love that. So 620 is what you need, and you heard it from me. Your middle score needs to be a 620 in order to qualify for the FHA, VA, or USDA, okay? Now, there are chances that you will find a lender that will say, oh, you don't need a 620. We'll let you slide with the 615 or something like that. There are lenders out there. I just don't, know of any, and I wouldn't suggest of any, because with that, trust and believe, your interest rate will be higher. Okay, you still should be getting something around the 3% and the high 2% for these government loans. The high 2% and the 3% category is where you should be landing if you're doing a rate and term or if you're doing a purchase loan on the government side. Okay, so we'll talk a little bit more about that as we go along. But I mentioned to you all, let's talk a little bit. We said, here's the credit application. We pulled your credit. We've gotten your scores. We know how much income you're making. So here comes the phone call from Shirley that says, congratulations, here's what you're eligible to purchase. Or congratulations, we can do your refinance, right? Okay, now, We've done that part. Now here comes the fun part. And I say, oh, but I'm going to need your documentation, right? Because we got to prove all this stuff. In some cases, not all, some cases will ask for tax returns. Now, very important, very, very important. If you take away nothing from this podcast today, Mortgage Money with Shirley, episode 3, Loan Programs Part 2. If you take away nothing, do understand, if you're in the midst of buying a property or refinancing a property, and you already have rental income property coming in, right? We have a lot of seasoned borrowers, right? They want to either add to their portfolio, their investment portfolio, or they want to purchase something new, or they want to refinance something new, and they need their tax returns to prove this rental income that they're getting in. Now, case in point, say that again, case in point, when you're trying to purchase a property or refinance, and I ask you for your tax returns, right? Your 2020 tax returns that aren't even due for another couple of weeks. Please don't call me and say, oh, yeah. My tax accountant just did my tax returns. And on my Schedule E, that's where you're going to put your rental income. On my Schedule E, she wrote off everything. And matter of fact, I put on an extra a couple more dollars for expenses. Now tell me, Shirley, what do I qualify for? The first thing I'm going to do is, wait a second, you did your tax returns, but did you actually click the button and file them? No, I didn't. Good. Whoa, pump your brakes. Don't file them just yet. Because here's the thing. What most investors or most homeowners don't really understand is the rental income looks good visually. But on paper, the way that mortgage brokers and lenders, okay, the underwriters, the way they calculate your rental income is not dollar for dollar. So you have a 4-unit, multi-unit property, and it's bringing in $8,000 a month, okay? You're looking at this $8,000 going, whoa, I just made a $96,000 income increase on top of my 9-to-5. Now, Shirley, I can qualify for $1 million house, right? And I'm going to say, I don't know, let's check it out. But what I am also going to say is that $96,000 worth of rental income that you amassed is not dollar for dollar. So it doesn't look like an additional $8,000 a month on paper to the lender. But what it does look like is about 75% of that $8,000 minus all this stuff that you wrote off on your Schedule E. So that is why it is so very important right here, right now. Call me, call your mortgage broker before you file your 2020 returns if you're trying to purchase a property or refinance property and you already have rental income coming in, okay? Because I do want to talk to you about it. I want to have a person-to-person or a one-on-one discussion with you about those tax returns before you file them. Because what you put on your Schedule E is important. And so we talk about that with our clients because I know I can beat it into your head and I still will have clients that call and say, hey, Shirley, I know it's Tuesday and Monday. I push that button and I e-file my tax returns and my Schedule E has all these expenses written off. And then I'm going to take a deep breath and I'm going to say, okay, well, let's see what we can qualify you for. And then you're going to get angry with me when I say, remember that $96,000 that you thought you amassed for that whole year of claiming all this rental income? That $96,000 doesn't equate to the lender, to the underwriter. Because for one, that 25% vacancy factor that we have to allow for, that's standard across the industry. Okay, that's not something that Shirley made up out of her head or the underwriter made up. No, that is standard across the industry. They have to allow for a 25% vacancy of your rental income just in the event a tenant moves out in the middle of the night. Imagine that. Imagine the tenant just packs up and walks out at 12 a.m. So there is a 25% vacancy factor. And I know I'm kind of, making light of all this, but it is so very important. If you take away nothing from this podcast, Mortgage Money with Shirley, if you take away nothing, make sure you understand your 2020 tax returns are due in a couple of weeks. If you're trying to purchase a house or refinance house and you already have rental income coming in, before you file that return and you're trying to buy something else, please, let's talk so that you don't get into what a little bit of an example that I will share with you all, what my other client ran into, okay? Okay, so let's fast forward. He filed his tax returns, and on his 2020 tax returns, he wrote off $40,000 worth of expenses. Not a problem. This is Los Angeles. It's a 2-unit, multi-unit property. He had some landscaping going on, bathroom renovation, kitchen renovation. He had a bunch of home improvements and renovation going on and landscaping, okay? $40,000, not unheard of. It's okay. It's allowed, right? Your tax advisor, tax accountant, whomever will let you know it's allowed, right? Okay, so he wrote off $40,000 worth of expenses. Now, mind you, he wanted every nickel and dollar counted for his rental income that we could give him. But what happened is the underwriter said, oh, okay. He brought in, let's just throw out a number. He brought in $50,000, okay? He brought in $50,000. Now, out of this $50,000, like I said, there's a bunch of expenses that we have to back out. Now, one of the expenses was that $40,000. So now, guess what? The $50,000 automatically goes to $10,000 because remember, he had $40,000 worth of expenses gone, done. So $50,000 worth of income, 40 of it is gone. Now, we're thinking, okay, we're done here. That's the end of the story. He's going to get a decline. But oh, not so fast. Again, he's dealing with his mortgage broker, Shirley. And so what happened is, just to cut to the end of the story, because again, these are some of the tips that once you call me, I'll share with you. But cut to the end of the story, right? Cut to end of the story. We were able to add back, I'll say that again. We were able to add back the $40,000 because of receipts and invoices. So if you're going to, okay, here's a tip I give to you. If you're going to write off all these expenses, make sure that you are keeping all of your Home Depot receipts, all of your Lowe's receipts, all of your contractor receipts, all of your construction receipts. Make sure whatever expenses that you are writing off, that they are a one-time expense. Not that, oh, I paid for security. Well, if you're going to securitize the property, it's probably going to be ongoing, right? You're probably going to put up security gates or a security alarm system. You're not going to just shut it off, right? You're going to probably keep monitoring the security alarm. So that's not a one-time expense. So what I'm saying to you is this, and again, call me, we'll talk about it. But with the expenses, the way that you can add them back, they have to be a one-time expense. And you have to have receipts and invoices, okay? So true story, this happened literally a couple days ago. So I thought I'd share that with you guys because it's so very important about these tax returns. And maybe in the next segment or the next episode, I'll talk to you all about the Schedule C. The Schedule C is where you're gonna put your self-employed income. And that's another touchy spot. But again, because the Schedule E was just fresh on my mind from this exact same example that happened a couple days ago, I wanted to share that with you all. But I'll share with you a story about the Schedule C as well. But just be mindful in thinking about this stuff as you're filing your tax returns for this year's tax season, okay? All right, so again, we talked about the credit application. We're gonna pull your credit, get a phone call from Shirley and say, hey, congratulations. And we're gonna talk about all the documentation that you will need. You'll need pay stubs. And I like to say the 2, 2, and 2 stuff, right? We need 2 recent pay stubs. We need 2 W-2s, so that's your 2020 and your 2019, and we'll need 2 bank statements, okay? Now, again, I said this before, know what you're making, because I'm gonna ask you for the documentation. And I don't want to mislead you. I don't want to call and say, hey, congratulations, congratulations. You qualified to buy $1 million house when really it's not $1 million that you qualify for because the way you get paid, you really qualify for $875. So make sure your documentation is forthcoming and that you can prove what you said. All right. Now, in some cases, and especially now, the guidelines have kind of jumped around and they're changing. We don't really have to have the 2, 2, and 2. We can do 2 pay stubs or 1 pay stub in some cases. We don't have to have 2 W-2s, 2020s and 2019s. Maybe we have 1 W-2. But the bank statements will need 60 days worth of assets or 2 months, right? So you give me all that stuff, your IDs, sometimes Social Security card. You give me all that stuff and we get you qualified. That's really all there is to the credit application process. That's the credit application to start building your file. That's really it. And all of that really can take, I don't know, how fast can you scan and email over some documents? So it doesn't take long, guys. And you've sweated out your hair, you sweated out the palms of your hands all night long for nothing. When you can just call, and I promise, on the phone with you guys, I'm just as lively and bubbly. Ask some of my clients, they'll tell you. I love this business, so I talk about it freely and candidly, and I will answer your questions to the best of my ability. If I don't know something, guess what? I'll go get the answer. So just the jitters and the fears of applying for getting a mortgage, really and truly, I hope I can make it the easiest, the most fearless process for you, okay? So that's the credit application side. Then we go through the documentation side, and then we get to the underwriting side, right? And I'm your go-to. I'm your liaison. I am your catalyst between you and the underwriter. I do all the talking for you, and of course, I want to close the loan just as bad as you do. I'll say that again, because a lot of our clients tend to forget. We want to close your loan just as bad as you do. I don't like working for free. So again, trust and believe you me, we will handle the underwriter. And because our rapport is such with the underwriter, we're going to 9 times out of 10, we're going to work our wheels of steel, and we're going to write up letters. We're going to do all that we can. As long as you have been truly qualified for the loan, we're going to do all that we can to get your loan closed. And right now, closing times are really quick. I mean, they're not that lengthy at all. And that's why a lot of this market here in California, inventory is dismal. You know, there's not a lot of housing inventory out there. You know, you're getting outbidded and you're going through these bidding wars. I get it. But once your offer is accepted on your purchase, or once your refinance says, guess what, you're approved, we're off to the races, and we're getting those loans closed in a timely fashion. I mean, seriously, we're whipping them out. So don't think that's a very longevity or a long-winded time frame or any of that stuff. Please don't think that, because that's not the case. And please don't have the fears and the qualms you have about applying for the loan. Just get her done, right? Call me. So I know this was a quick segment because I try to do 30 minutes and I'm just like, oh my gosh, I can talk about this stuff forever. But I just kind of wanted to bring it back home with these loan programs and credit application and documentation, and letting you all know that really the tax season is real. So let's talk about that before we have to end this segment. And like I said, I'm on every first and third Wednesdays of the month. It's just that if I have to change that day, I will let you all know. I will, announce it on Facebook or social media and let you know that, oh my gosh, wait a second, we're going to have to switch days. But I want to come to you all twice a month, bring to you Mortgage Money with Shirley on my podcast. Again, streaming live from YouTube, Morris Media Studios on YouTube. Again, that's Morris Media Studios on YouTube. If you have questions, comments, or concerns, you can certainly call in during this live broadcast. We're at area code 323-815-4204. And like I said, I will do my best to answer and respond to all of your questions, comments, or concerns that you may have. Like I said, I've got all these notes because I wanted to talk to you all so much about everything. Again, we talked about the credit score for government loans are down to 620. If you are refinancing for cash out, some of the what we call loan to values or LTVs have increased, which is good. So the cash out, again, during the pandemic, they kind of dipped into like a 65% loan to value on multi-units. That is now back to 70% on multi-units cash out. So you can go 70% of the value of your property and have that cash on hand. That's for multi-units. Single family, you can go up to 75% on a non-owner or investment property. So that has also changed, which is so very good. What else I want to talk to you guys about real quick? And then again, on jumbo loans, and this is for your primary owner occupied property, jumbo loans, we're up to 89.9%. So that's huge, almost 90% loan to value without PMI, without mortgage insurance. And all of you seasoned buyers and homeowners out there, you know what that mortgage insurance can do. It increases your payment because the mortgage insurance protects the lender, right? The mortgage insurance protects the lender. So in case if you decide to walk out on your property, why would you do that? The lender is going to definitely be able to indemnify himself with your insurance payments. So the good thing is, like I said, 89.9% on these jumbo loan cash out loans. There's no MI. That's huge. That's huge because everyone knows if you don't have 20% worth of equity in the property or your loan to value doesn't stop at 80%, here comes that PMI. And that's standard across the industry, right? You're supposed to have this PMI. Well, there's some lenders out there that have programs that will not make you have this PMI, this mortgage insurance. So this is huge. This is good stuff. And what else? One thing too that I mentioned about the credit, you know how your score is higher on Credit Karma or some of those internet websites, and then when I pull it, it's a little lower. One thing that kind of gets in the way, and I touched on this a couple episodes ago, is the student loan factor. So we'll talk more about the student loan balances and the payments. We'll talk a little bit more about that, but I will say this real quick, this little tip about the student loan. If you have an outstanding student loan balance right now and the payments are deferred or that you're not making any payments on your student loan and their payment is not showing up on your credit report, well, it used to be, okay, during the pandemic and a little bit before, right, they used to, underwriters being they, used to have a payment factor of 1% of that outstanding balance. Well, that 1% has now been decreased to 5%, like 0.5, I keep saying 5%, but it's 0.5% of that balance. So if you owe a $10,000 student loan balance and there's no payment reflecting on that credit report, we're going to assign you a payment, right? And it's going to be 0.5% of that $10,000 or $50. That's it, right? That's it. So you're doing good. So I just want to kind of keep some of these points out to you all, some of these tips that I know of. But again, our segments, our episode, our podcast is really a 30-minute session on the first and third Wednesday of each month, right here, Mortgage Money with your girl, Shirley. So we're going to have to wrap it. And I am so glad that you all tuned in today. Again, you can always replay, ask any questions, comments, or concerns that you may have. But again, I just love this business. So if you want to talk with me direct, I'm with Clear Sky Mortgage and Realty. I'm at area code 818-720-7575. Again, that's area code 818-720-7575. And my Facebook page is Clear Sky Mortgage and Realty. So I hope you all enjoyed today's episode, and I'll see you again. Thank you and have a great afternoon. Bye-bye.